Hello and welcome to episode 2 of Talking Central Banks podcast with me, Karan Merici. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about Federal Reserve's monetary policy review, the latest version of which is expected to see the light of the day by the end of this year. Our special guest tonight is veteran economist and globally recognized expert on monetary economics, Jay Bryson, who was recently the managing director and the chief economist for Wells Fargo's corporate investment bank, a position that he held between 2018 and 25. He was Wells Fargo's global economist between 1998 and 2018. And before joining Wells Fargo in 98, Jay was an economist in the Division of International Finance at the Fed Reserve Board in Washington, D.C. Jay started his career as an assistant professor of economics at the University of Alabama and holds a PhD in economics from the University of North Carolina, Chapel Hill. Welcome to the show, Jay.
Well, thanks for having me.
My pleasure. So, Jay, let's talk about the review business right from the start. Under the 2012-2019 framework period, inflation largely remained below the 2% threshold for much of the pre-COVID era. Yet liftoff happened 2016 onwards, though taper tantrums actually happened much earlier, primarily based on 5-year forward expectations. I believe that this slowed down the US economy uh, and had detrimental effects on the global supply side, supplying to the US household consumption. Do you think this rate strategy set a wrong precedent of what not to do for the Fed's post-COVID monetary strategy?
Yeah, so the post-COVID and the pre-COVID world, I think we're completely different, right? If you go back to the pre-COVID world, so this is post-global financial crisis. And as you point out, the Fed's target inflation rate never really got above 2%. Yet starting in 2015 and then in 2016, they were actually lifting policy or raising the Fed funds rate. So I guess the question is, why were they doing that at the time? And I think you had been at zero interest rates for 7 years, which was unprecedented. And by any stretch of how you measure monetary policy at the time was very accommodative. And so when you get into 2015, when the Fed first hiked rates by 25 basis points, again, they go from 0 to 25. It's still very, very accommodative. But you look at where the unemployment rate was at the time. It was in 2017 or 15 rather. It was at 4.7%. It had come down from 10%. And they waited a whole year before they hiked again in the end of 2016. At that point, the unemployment rate was nearing 4%. And so, I think they what they were doing back during that period of time is they were looking forward and they realized that policy was very, very accommodative. They had to move to a more neutral sort of rate. Now, where neutral was, different. It's hard to tell, right? But it's probably not at 25 basis points or even 50 basis points. And so that's what they were doing then. And then, and maybe I'm sure we'll talk about this. I think that then colored their perceptions in the post-COVID world when all of a sudden inflation took off, and arguably they were very, very slow to tighten policy at that time.
Right. Jay, I think the low inflation had a direct bearing over the R star during the first review period. And the FOMC lacked sufficient ammunition given the proximity to the effective lower bound. The post GFC liftoff was probably meant to extract that ammunition at the time. Post COVID, however, that urgency wasn't really seen, in my view. What do you think about this anomaly, Jay?
Well, I think it's so again, I mentioned this word colored before. I think that their perceptions of the world may have been colored by the pre-COVID experience. During that whole period of time, you didn't get inflation above, at least on a sustained basis, above 2%. And, if you're a central banker, kind of the last thing you want is a potential deflationary spiral to set in, kind of like what Japan had for roughly 30 years. Once you get into a potential deflationary spiral, or even a mild deflationary episode, it's really difficult to get out of that. So again, I think their perceptions of the world was colored by that post global financial crisis, sort of period. If you go back right after COVID happened and you saw the inflation start to pick up at that point, the Fed was talking that they thought inflation was going to be, quote, transitory. And, we can argue about how transitory it was or not. And so initially, no, there wasn't an urgency to lift rates. But after about a year, then they became very, very urgent, right? So between early 22 and the summer of 23, they raised rates by 525 basis points. I think it's the fastest pace of tightening that we've, seen, at least in the modern era, right? And so, yes, they weren't urgent, at least initially, but boy, they certainly caught up later on. And, in that 525 basis point tightening cycle, there was 4 consecutive meetings in which they raised the Fed funds rate by 75 basis points. And so they went from very accommodative to rather restrictive in a very short period of time.
So Jay, how convinced are you with the transitory narrative that they were building that at the time?
Well, I can see why the Fed thought things may have been transitory at the period of time. I think they over or underestimated the amount of stimulus that was actually in the pipeline at the time. Not only with monetary policy being very, very stimulative, but then fiscal policy being quite stimulative as well. And so, I mean, there were people on the FOMC, most notably James Bullard, who was the president of the St. Louis Fed at the time, who was saying, we got to get going, guys. We got to get going fast. The whole FOMC, I think, arguably missed the boat on that. But again, I think that they caught up rather quickly, and we're not back at 2% right now, but the measure of inflation that the Fed looks at, the PCE deflator or the core PCE deflator as well, has been below 3% now for quite some time. And so they're not back to 2%, but we're certainly at not at 9% inflation either.
Right, right. So Jay, during the first review period, Nairo was apparently lower, and liftoff happened because, frankly, experts had no idea when that point would be reached. Therefore, when taper tantrums actually appeared in 2014-15, the impact on the economy was debilitating, slowing job creation in the process. So, Jay, your thoughts on this and lessons for the second review?
So first of all, I don't know if I'd use the word debilitating to talk to describe the effects on the economy. So, I mean, for instance, if you look at 2014, the year before they started to tighten, growth in non-farm payrolls averaged about 250,000 per month. 2015, and they didn't hike until the end of that year there. Growth had in non-farm payrolls was still averaged 225. And in 2016, it was roughly around 200,000. So there was a slowdown going on in terms of job creation growth. But if you're still creating jobs, 175,000 per month, 200,000, I'd still say that's pretty good payroll growth, sorts of numbers. Again, the unemployment rate, had fallen back down to around 4%. Or so, and it kept trending lower over that period of time. So when you look at it, you wouldn't say that the labor market was falling apart. What effects does this have on the second review sort of process that's underway right now? I mean, in the framework that has been in place, at least formally, at this point, is it's an asymmetric 2% target. That is,
Right.
what the Fed was saying is, okay, we want to hit 2%, but if we undershoot 2% for a period
Yeah.
of time, then we'll let inflation run a little bit above 2%,
Yeah.
in order to average 2% over some
Mm.
undefined period of time. The idea
Right.
here is, and it goes back to the pre-COVID sort of period, is you don't want to have people starting to think inflation is going to continue to move lower and lower and lower and potentially
Yeah.
get into the deflationary sorts of situation. So I think this time around, given the fact that we've had this overshoot, a big overshoot in terms of inflation, I think what you're going to see is they're going to drop that, call it asymmetric sort of target for inflation. That is,
Right.
try to go for 2%. If you're running above 2%, then then tighten policy and don't worry about trying to average it out over a period of time.
So, Jay, we'll talk about this stuff later on. But I think the more important question right now is that in the first framework, the PCE unemployment and reserves was unrealistic as compared to the actual numbers throughout the 2012-19 period. And surprisingly, this happened in the pre-COVID era when forecasts were actually not going haywire for lack of high-frequency data as compared to the post-COVID period. So the question is, Jay, that why did Fed forecasters fail to assess the ground reality reliably for such a long-term period, in your opinion?
Well, so first of all, I don't know if it was just the Fed. I think a lot of private
Yeah.
sector forecasters, got
Mm,
it wrong as well. I mean, there were, people
mm,
in 2010, 2011 who were saying it was going to be sort of like a V-shaped sort of recovery. And,
yeah.
and I think
Mm,
what probably made people at the Fed and maybe, arguably a lot of private sector forecasters realized as well is when you have a balance sheet recession like the financial crisis,
yeah.
that is, to use a word that you used earlier, is
Yeah.
debilitating to the
Yeah.
economy. Banks have to repair their balance sheets. That takes a long period of time. Households who saw their home equity get crushed during the housing downturn here takes a long time for them to repair their balance sheets. And so there's probably an underappreciation for when you go into a deep balance sheet recession like we had here, post financial crisis, just how long it takes to climb your way out of it. And then the last thing I would point out is fiscal policy in 2000, in the early part of the last decade, in the United States was actually contractionary. It was restrictive, due to concerns here in the United States. And so, it was the fact that, again, you have this depressed sort of economy, you have fiscal consolidation going on. I think there was just an underappreciation of how much drag there was on the economy at the time.
The proximity to the ELB, Jay, spooked the Fed's 2018 review strategy. And it was assumed that lower effective fund rate would ensure that downward risk to both employment and inflation would be a reality. I believe that in order to maintain the sanctity of forward guidance, the Fed therefore targeted inflation slightly above the 2% threshold to mitigate this problem. And I think you did speak about this earlier. This strategy was, however, nullified when COVID hit, and the opposite actually happened as upward pressure on inflation was the new problem. So, Jay, do you think the strategy should have been sandboxed to factor in an exigency like COVID, or you think that an event like COVID could not have been realistically factored in by the Fed at the time?
Well, yeah, I mean, the pandemic was the last time we saw a pandemic,
Mm,
on a global scale, was,
mm,
the Spanish flu, the so-called Spanish flu of
right.
about 100 years ago. And
Yeah.
yeah, up until December of 2019, nobody had even heard of COVID. It's completely
Right.
unforeseen. Right.
Right.
So I don't fault the Fed for not seeing COVID because none of us saw that coming. It's just
Yeah.
unforecast.
Mm.
We talk about strategy. Strategy is a long-term sort of thing. You don't want to be changing your strategy, every month or so. Then it's not a strategy anymore. Strategy implies something
Yeah.
long-term. And, when the Fed undertook its strategy review, COVID wasn't around during the actual review sort of process. You had been dealing with a decade of below target in inflation, and so that's what really motivated the Fed's strategy over the last few years here. The good thing is that you want to have a long-term strategy, but you don't want to make it permanent either. The world
Right.
changes over time, right? And so every 5 years they have this so-called strategy review. We're going through one right
Yeah.
now, and
Yeah.
it's a good thing again, to revisit your strategy every so often just to make sure it's still a viable strategy.
Right. The 2018 20 review focused a lot on unconventional monetary policy tools, such as the QE, which in a way eventually went overboard during the pandemic. The Fed's balance sheet actually expanded by over 70% in 2020 alone. How effective was that strategy, according to you, Ajay? And should there be any conditions attached to tools during events such as the pandemic, in your opinion?
So I would say that initially quantitative easing
Mm.
in the spring of 2020, I think was very effective because what it did is it helped to reliquefy markets. As the world was shutting down in March of 2020, financial markets became very illiquid. Corporate bond spreads blew out. Even you saw dislocations in the treasury market. And
Right.
the Fed coming in, buying treasuries, buying its other programs that it had in place to reliquefy markets, I think was very, very effective. Now, I would also argue that later on, when the economy really started to turn around, that it probably started to become counterproductive for the Fed to continue to buy treasury securities and mortgage-backed securities when the economy
Right.
was starting to really boom. I mean, what you had was this
Mm.
tremendous amount of fiscal expansion here in the United States with the three different programs, fiscal stimulus
Right.
programs that were put in place. So, again, initially I thought it was again very, very effective, but I think eventually it became counterproductive.
How different do you think the 24-25 review would be as compared to the 2018 20 review, Jay? Given the different modalities involved? And what changes would this bring to the price stability and unemployment maximization trade-off for the Fed?
Yeah, so I think the first thing to keep in mind is that mandate, that so-called dual mandate of quote price
Mm,
stability and quote full employment, that is
mm,
given to the Federal Reserve by the Congress of the United States. And the Fed takes that mandate very, very seriously. I mean, they're not accountable to the public on a day by day sort of basis, but you do have to have political accountability. You just can't have the Fed running amok and doing whatever it wants to do, in a democracy. And so it takes that dual mandate very, very seriously. And I don't think you're going to see any changes from that. It's not like they're going to say we're going to focus only on price stability because
right.
then they're jettisoning the mandate that's been given to them by Congress. So,
Yeah.
within that constraint, if you will, there's going to be certain sort
Right.
of tweaks to that. And I think the biggest tweak that you will see, and I mentioned this earlier before, you'll move from
Mm,
something that's quote asymmetric in terms of what they define as price stability. That is, if they undershoot 2% for a period of time, they'll try to go a little bit above 2% to make it average out to 2% over time. I think you're going to
Yeah.
see them abandon that and move more back to a symmetric sort of 2% target. If you get above 2%, even if you were below for a period of time, they're not going to worry anymore about trying to overshoot the target. I think once you go above 2%, you'll start to see, tighter monetary policy. So I think for me, I think that's probably going to be the biggest change to their strategy going forward.
Since we are talking about this, Jay, how realistic is the dual mandate for the Fed, given that price stability has always remained symmetric, as you pointed out, for the Fed's monetary strategy since 2016, if I'm correct?
Well, I think that the correct question would be how um, appropriate is that for the United States? How appropriate is it for Congress to give a dual mandate to the Federal Reserve? I guess what I would say is I would compare it to the ECB. Okay, the ECB, the European Central Bank, essentially has one mandate, and that's price stability.
Yeah.
And that was given to it, in the Maastricht Treaty over 30 years ago, which set up
Mm.
European Monetary Union. One of the reason we have the ECB structured the way it is today is because of Germany, who was the most at the time was the big, well, still is the largest economy in Europe, and so they structured the ECB to look very much like the German Bundesbank. And the German
Right.
Bundesbank was given price stability as its only mandate because you
Mm.
think of the political economy of Germany, you think of the hyperinflation of the 1920s, which then arguably led to the rise of Hitler and, et cetera. And so the Germans were deathly afraid of inflation. And so when they set up the Bundesbank, that's why it only had one mandate and consequently why the ECB does. We here in the United States have never had a hyperinflation, certainly not to the extent that Germany has. And
Mm.
we here in the United States, when the unemployment rate rises, there's a lot of political blowback from that. And
Right.
so we've had this dual mandate in the United States going on 50 years, again, because of the political economy of the US. And
Right.
um, and generally that mandate, you don't have problems with it. In other words, if you have a demand side shock, if demand collapses, inflation comes down, unemployment goes up, and both of those things tell the Fed to ease policy. Conversely, if demand really takes off because of, say, fiscal stimulus, inflation goes
Right.
up, unemployment goes down, then
Mm.
the policy prescription is tighten policy. They're both
Mm.
in agreement at that point. It's when you get
Right.
it's when you get a supply shock, like either during COVID or arguably with tariffs as
Mm.
well, and that's when it puts the Fed into a little bit of a pickle. And I would say that therefore other policymakers have to do their part when a supply shock comes along. So again,
Mm.
I just don't see, I don't think Congress, at least not in the foreseeable future, will change the so-called dual mandate of the Fed. And if that's the case, then the Fed just has to live with that political constraint and try to do the best job that they can do.
Very interesting, Jay. Well, with this background, can you also talk about the asymmetric and symmetric approaches to price stability in the 25 review? I mean, I know you talked about that earlier, but what changes in the reaction and based on this background, what changes in the reaction function do you foresee?
So I guess, in terms of the reaction function, again, the Fed has two
Mm.
objectives in its reaction function: price stability and
Mm.
unemployment. And
Mm.
arguably over the last, well, after the financial crisis and in the early days of COVID,
Mm.
Fed put a lot more weight on its unemployment objective than in its price objective, because quite frankly, we didn't have an inflation problem. If anything, inflation was too
Right.
low. right? And so they arguably put more weight on their unemployment objective. Going
Right.
forward, I think, and then so what happened then once you had once COVID happened and inflation really took off, their reaction function shift. They still had two objectives in their reaction function, but they put a lot more weight on inflation. There was a period of
Right.
time when they were tightening policy,
Mm.
which I mentioned earlier,
Mm.
that
Yeah.
the weight on unemployment was it's effectively zero at the time.
Yeah.
I think,
Mm.
once you in the new with a new framework, at least initially, they'll put equal weights on both unemployment and inflation. And I would argue, like right now, that's probably where they're moving to, right? They're starting to play, it looks like the labor market here in the United States is starting to soften up a little bit. And if the
Right.
Fed cuts rates in September, which, a lot of folks
Mm.
think that they will, then arguably they're starting to put a little bit more weight again on the unemployment part of their dual mandate.
Right. Coming to the communications part, Jay, I think a lot of discussion is required in this department, but I think very few people talk about that. In your opinion, what is the best way the Fed can communicate to the public about its monetary stance and tools employed? Given that communication is a very important component of the framework as we speak.
Right. Yeah. So
Mm.
why is communication so important? And the idea
Mm.
is if agents, consumers, and businesses know what the Fed is or has a good idea what the Fed's going to do, that helps them form expectations better, and then that gives you a better economic outcome altogether. If you go back to 30 years ago, the Fed was very secretive in what it did. So the Fed would have an FOMC meeting and people wouldn't, nothing was ever communicated. The market wouldn't know until the next day when the Fed started to operate in the market to
Right.
either, drain reserves or add reserves to change interest
Mm.
rates. And
Right.
starting with the Greenspan Fed back in the 1990s, they started to
Yeah.
move to a little bit more open communication, a little bit more transparency. Now, there's
Mm.
an inherent, I guess, trade-off here. That is,
Mm.
I mean, you could move to full transparency. You could have open board meetings, which probably be a little bit counterproductive if it was
Mm.
fully open. The Fed could completely pre-commit and say, okay, we're going to raise rates at 25 basis points per meeting for the
Mm.
next 5 meetings, or pick a number. But the
Mm.
trade-off there is things happen to the economy that are either unforeseen or we just don't completely understand. So you don't want to completely pre-commit and have full open communications. And so the Fed, like over the years, and many central banks have also done this, have become much
Mm.
more transparent in their communications. And
Right.
I don't, at this point, I can't, there's nothing that really strikes me as something that the Fed needs to do even more than what they're doing. I mean, I think the dot plot
Right.
provides some good information at the time of the meeting. It's a
Right.
best guess of where
Mm.
they think interest rates will be. That helps to form the word that you used earlier, forward guidance. But you also have to have some optionality involved as well. You can't be completely boxed
Mm.
in with monetary
Mm.
policy because things change, right? And so they certainly, if you take a big picture view of history, the last 30 years, the Fed has moved
Mm.
into a lot more transparency, a lot more open communication. And
Mm.
I give them a pretty high marks for how they communicate with the public today.
And I think, Jay, ever since the introduction of New Zealand style flexible inflation targeting, I think communication has become even more important over the years. Any thoughts on that?
Well, given the fact that if you do have these
Mm.
inflation targets, I mean, that helps.
Mm.
That I think helps for people to try to figure out what it is that the central banks are trying to do. And
Yeah.
that's just one part of
Mm.
by having a mandate, which again is given it. The New Zealand central bank was the first to move to an inflation
Mm.
target. but that was given to them by the government of New Zealand. And if you
Right.
look around the world at
Mm,
other central banks that have defined inflation
mm,
targets, a numerical number, whether it's the Bank of England or the Bank of Canada, the Bank of New Zealand, etc., Bank of Australia, Reserve Bank of Australia, all those inflation numbers are given by the government.
right.
And yeah, I think it's an effective communication strategy so the public understands and helps to form
Mm,
expectations, which are very
mm,
important, getting a better monetary policy outcome.
right. It's a season of tariffs, Jay. So gotta ask something on about its impact. What impact do you see of the current tariff regime on the ongoing framework review? I bet they did not think about that earlier.
No, probably not, but certainly not back during
Yeah,
the last framework. Although,
yeah,
the
yeah,
first Trump administration did put
mm,
some tariffs on, but not to the same
mm,
extent that we have here as well.
yeah,
I don't think tariffs will play at least not an explicit role in
mm,
the framework. Going forward, I think what it all boils down to is there are two objectives that again that's given to them by Congress, and that is full
mm,
employment and inflation. How best to hit those sorts
mm,
of targets, and tariffs arguably, at least in theory, cause the inflation rate to go up and the unemployment rate to also go up. It's a supply shock
yeah,
to the economy, right? But and so I think, given the framework that they have of this dual mandate, they'll try to manage that as best as possible. But I don't think you're going to see tariffs mentioned in the explicitly in that sort of framework.
right. Interesting paper by Thomas Dreshel of the University of Maryland, titled "Political Pressure on the Fed." So Dreshel basically states that political pressure to ease monetary policy actually increases price level and does not bring about positive effects on economic activity. What are your views considering the mounting pressure on Powell to remain dovish, given the fact that I think we are waiting for what he would say at Jackson Hole?
I totally agree that I think it's counterproductive
Mm,
to try
yeah,
to have the Fed do something that it probably shouldn't be doing, like easing policy significantly right now. Because
right,
what you risk happening is inflation expectations becoming unmoored, right? So if people start to believe there's a lot of political pressure on the Fed to ease policy when arguably they shouldn't be, then they start to expect higher inflation. And that's problematic because most statistical models that I'm familiar with show that inflation expectations are a very important part of actual inflation. That is, if you expect prices to be significantly higher a year from now than they are right now, you and
right,
everybody else has a real incentive to go out and buy goods and services now before their prices go up. And if everyone's
right,
doing that, guess what happens? Prices go up because there's excess
yeah,
demand. So I think it's very counterproductive again for politicians to be trying to dictate to central banks, what to do. I think what we've learned over the years, and the empirical literature shows this, is independent central banks that are filled with technocrats. They end up with pretty good economic outcomes. Are they perfect? No, of course not. But you generally you end up with lower inflation there, and lower inflation is good for long-term economic activity because then businesses can plan their capital spending budgets and
right,
better than in a highly volatile situation in terms of inflation.
right. Jay, any thoughts on the Fed's disinterest in maintaining the existence of the U star in the current review? I know it's a controversial question, Jay, and I think a lot of economists do not want to talk about that. But if I insist, is it really impossible to predict a reliable yardstick for unemployment given the fact that the American economy is a highly organized economy?
Yeah, so you mentioned use star, and so what that would be the
Yeah,
so-called NAIRU, quote, full employment.
yeah,
It goes by a lot of different sorts of names. I think it
yeah,
is. I used this word before. I think it is counterproductive, or not, or at least
mm,
not a good use of time to
yeah,
try to really predict where that is.
mm,
It's really based on a lot of underlying structural sort of factors, a lot of demographic sort of factors. So, for instance, 50 years ago or so, here in the United States, full employment, quote, full employment, NAIRU, U star, whatever you want to call it, was
mm,
probably somewhere around 4.5%. And then what
right,
happened was, with many women entering the labor force for the first time, and many baby boomers coming into the labor force for the first
mm,
time. People who
yeah,
don't have highly developed skills yet, it's harder for them to find jobs. And so-called U star, most people would estimate throughout the late 60s, early 70s, rose to 6.5, maybe
mm,
7, as high as 7%. Again, we don't
right,
really know. It's unobservable. You try to have to
right,
estimate these things. Today, it's certainly much lower than that. And, if we
yeah,
do have a big crackdown on immigration here in this country,
right,
arguably that would cause the so-called NAIRU U star to be even lower. So I don't think it's a great use of time to really try to focus on where that is. Better, I think, is to observe what's happening in the economy, what's happening to wages in the economy. And
right,
if the labor market is too tight, you should see wages starting to accelerate, and vice versa. And that will have then some effects on inflation. So I think you just have to be watching the incoming data, and that'll give you a sense of whether the labor market is too tight or not.
But Jay, I mean, the question is that if you do not have a reliable U star, then what impact would it have on the Philip curve? Because then, how would the inflation and unemployment estimates pan out in the near term?
There's always going to be uncertainty about that. The same thing with the Phillips curve. It's not like there's a Phillips
Mm,
curve in the sky that we can look to and say, "Oh, this is where we are
mm,
on that." We have to try to estimate those sorts of
mm,
try to estimate those sorts of things. So again, I think
right.
what you have to do is you have to be looking at the incoming data. You have to be watching it like a
Mm,
hawk, and try to
mm,
set monetary policy on the incoming data rather than trying to predict where things may be at some point in the future based on
mm,
things like U star, which is unobservable, or so-called R star, which is the neutral Fed funds
mm,
rate. I
right.
think it's more of you
Mm.
have to be watching the incoming data and try to make predictions as best as you can, realizing you're never ever going to get it completely right.
So that's all I have for today, Jay. Thank you so much for your time and being part
Thanks
of the
for
show. It's an
thanks
honor.
for having me. It's been a pleasure.
My pleasure. Thank you very much.